Good evening, everybody. AI is changing the game, but not the way most people think. It's driving deflation and creating a macroeconomic shift. Yet bonds, not AI, still claim the top spot on our list of actively flowing financial currents. Hello, my name is Daniel Young, and this is Adaptive Perspective. Every week, we separate currents from noise and opportunity from fear using an income-focused strategy in closed-end funds. It's not polished, as you can see. It's definitely not scripted, and it's definitely not herd thinking. We don't chase headlines. We navigate markets. Now, let me be clear. I'm not a financial advisor or a fiduciary. I'm an income hunter, a strategist who filters the noise, follows the data, and targets real cash flow, even when that means taking a different course. So let's step into this week's waters and see what's actually moving. Have you ever heard the quote, calm waters never made a savvy sailor? That is our theme for the week, which means it's time we revisit how we think about the market. Do you remember the four financial bodies of water? Currents, waves, ripples, and tides. Currents exist whether you like it or not, and they're always moving. Waves are big events, wars, recessions, policy shocks. Ripples are smaller disruptions. The tides are the long term consequences, often from our own decisions. This week, it was seemingly quiet. No obvious massive waves, no dominant headlines. And that created a different problem. When the noise dropped this week, something else got louder. Every analysis I read pointed to the same place: equities, AI, and the big names, over and over and over again. And it made me pause because when everyone, even the contrarians, start saying the same thing, you don't follow it. You question it. And here's what I realized: even the different voices, the contrarian voices, even the different voices were still focused on reflections, not currents. And that's when I went back to structure. So right now there are four actual currents, or four top flowing currents: bonds and select bond proxies, real estate, end-to-end energy, and technology beyond the big caps. All of them are moving, but not equally. Bonds still lead. So strip everything down, filter out all the noise, and see what you have. The economy is growing. AI is lowering cost. Energy expansion is lowering cost. Rate cuts are being signaled. That's a deflationary setup. And in that environment, stocks lose their inflation advantage and bonds gain strength. That's not my opinion. That's the market structure. So why the confusion? I think it comes from two things. One, bad labels. The market is full of categories that don't actually help you think: consumer, defensive, and growth. Most of it overlaps, most of it distracts. Everything uses technology now, everything touches energy. So instead of chasing labels, I focus on function and flow. Two, misreading the current. Yes, stocks can outperform over long periods, but that depends on the environment. And right now, we're not in an inflation driven expansion. We're moving towards a deflationary cycle, and that changes everything. Now, this is where it gets interesting. AI is being treated like a stock story. It's not, it's a macro force, and it's doing two things at once. It's helping bonds by lowering cost and increasing productivity and supporting lower rates, but it's also competing with bonds with massive debt issuance, huge capital demand, and pressure on yields. So, no, the bond story isn't simple anymore, but it's still intact. Most people miss that because the herd sees AI and runs to stocks. They're chasing the visible layer where the water looks calm, but they don't see what's moving underneath. AI isn't replacing the bond current, it's rewiring it. So I'd love to tell you something new, something more exciting and something different, but I'm not going to pretend there's a better current just to sound different because there isn't. This is still a bond led market. And that understanding is key as we move into this week's closed end fund snapshot and look at the funds aligned with the strongest currents. So let me change my screen here. Always interesting. Zoom likes to update features. Things get a little confusing. So here's the initial breakdown. This is let's say the top eight. Yeah, top eight funds that fit the parameters. These are bonds and bonds proxies for the most part. Top and bottom is real estate. IGR is global real estate. HFRO is more North American real estate. BRW isn't so much a bond fund anymore. It's just a massive income vehicle. They will target anything and everything, but not necessarily bonds. HGLB has bonds, but it's playing into other proxies. So I'll hover over these cards or these notes. You can pause and read. BRW, and then we'll get back to HGLB. Oops. PHK, PTY, PDO, DLY, and then HFRO. Sorry, that is in the way. So there, followed by there. So HGLB. HGLB has bonds in it, and it plays into those other bond proxy categories, real estate, technology, and energy. But it's it's I am not opposed to risk, but I am suspect of this risk. Midwave Wireless remains 35% of their portfolio. It has, and it hasn't gone away. So in that sense, it's at least stable. What's risky right now is this company. I like this company. I think it has great potential. But since their IPO, it's been pretty volatile, leadership wise, structure wise, who they're trying to shelter under their umbrella, and then the price. So the initial public offering bolstered HGLB's net asset value, like it raised it and it raised the price. That's great. But if Fermi caters, like right now it's been volatile, but if it really crashes, then it's going to bring down the NAV and it's going to bring down the price. So with it sitting higher than where we bought it and with their internal struggles, it's not going to make my list. But it's more of a watchful eye because if as much as I love Fermi and what it's trying to do, if that falters and fails, or they drop it off their funds, then it's going to bring down the NAV and bring down the price, and then it becomes a much more palatable buy. So while all of them could stay on the list, it's hard to look away from bonds. And I get it. It's bonds and bonds proxies outside of BRW and HGLB, which has really become a portfolio when it can. Like it's got a little bit of everything. And it includes some bond proxies, but it's not everything in their portfolio. They've got retail and other stuff in there too. So to stay true to current, we're going to have to eliminate the top and the one bottom and focus on these four. Now, I'll go back to as I filter this list, I look at targets based on the system that I've discussed at length. I'm not going to talk about it in this video. I look at pay style or I look at dividend policy, and then I look at overall yield and I try to pick something 9% and above. HFRO makes the list because, and yes, it's paying a lower dividend because it's still at this crazy discount. So at 46% off, 45% off, that's like paying 54 cents for every dollar invested. That's a worthy contender, but it's not going to make the list because as much as I think real estate, gosh, much as I see a resurgence in real estate, it's still not It's like a tributary of bonds. It's like you're looking at bonds are the main river, and then flowing behind it or flowing into it, or however you want to wire that in your head, then you have real estate. And IGR wouldn't generally make the list because it's premium and it's generally discounted, right? But for me in my portfolio, it's a dollar cost average move, and I've said it for a while. I mean, below $5, it's for sure a great dollar cost average move, but I'd also have to pass on other funds. So I don't mind. I used to not like buying things in premium. PIMCO taught me a different story. Um, PIMCO's funds are premium relative to the 52-week rolling average discount. PTY remains the best deal. IGR generally sells for a discount. Right now, it doesn't, and it hasn't for a while. But what would make me buy it is the fact that it's a dollar cost average move. But right now, I still think we need to look past these second, third, and fourth feeds and focus on bonds. And that leaves these. Now, which you pick would be up to you. It's your money. I'm not going to take your money or tell you where to invest it. For me, I'm not investing tomorrow. We bought 3 weeks ago, 2 weeks ago, and like a diligent dollar cost average guy, I'm going to wait the extra week and try to make it an actual month between buys. Of which case I'll get the full effect of April, I believe. So that value will go up and we'll have more to spend or more to invest. We'll say it that way. But as to which of these you like, PHK is the legacy fund at a 12% yield, which is just insane to me. PTY has the current overall best performance. PDO has fared the best recently, but it's a term fund. Um, let's see. So takeaways should be a space there. Um, yeah, it's legacy portfolio, PTY, crazy ongoing performance, PDO term fund, but a multi-sector specialist. There we go. And then DOY is this structured product specialist. And these four funds just seem to outperform the market. Like pick a stage and they're just rolling along, whether it's inflationary or deflationary, they're just kicking it along. So of the four, if it were me, and I'm not buying tomorrow, but if it were me, I would probably pick up another 100 pack of all four. And that's, I mean, I could type in 100 here and we could see the values, but the easiest way is if we just look up at the overall sum of rows and times it by 100, that's 4,400, which is less than 5 grand. And then if you look at the dividend, same thing, times it by 100. So now it's a $41 a month increase in my overall portfolio dividends. So that's where I will leave it with you. Real estate is tempting. BRW's income vehicle, aggressive income vehicle is tempting. And HGLB, it's tempting, but I mean, tempting on its own, but the gosh, as much as I love Fermi and its idea, it's a cautionary tale for now. So that takes HGLB off. BRW, great income vehicle, but not an outright bond fund. And then real estate, I still think it's a great market for real estate. And I think the fears on real estate are overblown. But to stay in the top current or the lead current, we just got to go with bonds. So that's the final four for the week. So beyond that, I'll leave you with this. The herd hears noise and runs. Runs where? Sometimes they scatter, sometimes they chase greed. But sometimes that loudest noise in the market isn't what matters most. So while they chase reflections on the surface, we stay in the current. Because when you're in the right current, you don't have to force progress. The market does the work and it pays you while it pulls you forward. So that's all I got for the week. And I will see you next Sunday. And between now and then, have a great week, everyone. Whatever you have planned for the week, I hope it goes exceptionally well. I hope you cross some things off your to-do list, and I know it's going to get filled back up. But I hope you make some significant progress in whatever it is you're working on. And for everyone who loves Star Wars, like me and my daughter, may the fourth be with you. And then remember the fifth and sixth, however you want to remember them. Revenge of the Fifth, Revenge of the Sixth. That gets into the Jedi and gosh, the Jedi and Sith side of things. So whatever you have for the week, I wish you well. I wish your investments well. I wish you in general well. Make progress, do the hard stuff. Don't listen to the noise, don't get distracted, and do the things you need to do, as hard or as simple as they may be. So have a great week, everybody. I will see you next weekend. Bye-bye.